But we have much more debt now, right? The national debt is 34.1 trillion and rising. We have a couple hundred trillion of unfunded liabilities. Back then, back in the 1980s, 1990s, we were still pretending we were going to do something about entitlements, about Social Security, about Medicare, that there was going to be some effort to, fix the problem before it blew up. Well, nobody at this point believes that we're going to do anything about stopping the bomb from going off. In fact, it's already gone off. We've already passed the point.
Today, we explore economist Peter Schiff's alarming outlook on the U.S. economy. Schiff warns that the Federal Reserve plans to cut interest rates not due to economic struggles, but as a response to soaring inflation. Despite the appearance of prosperity, Schiff notes that current interest rates are not unusually high when considering the staggering $34.1 trillion national debt and hundreds of trillions in unfunded liabilities. Drawing parallels to individual credit scores, Schiff suggests the U.S.'s financial FICO score would be in dire straits. Despite slight credit rating downgrades, the official rating doesn't truly reflect the nation's deteriorating financial circumstances. In contrast to the 80s and 90s, when efforts were made to address issues like Social Security and Medicare, Schiff argues that we've not only failed to prevent a financial crisis, it has already occurred, with no clear plan in sight. With that, let's dive into the video to hear Peter's full explanation.
The Fed is going to be cutting rates. Maybe they're going to start in March or maybe April, or hard to say, but they're going to start and they're going to keep cutting. And so this is great because we're not going to have a big drop in earnings that you might have in a recession, because the Fed's not cutting rates because the economy is bad. It's cutting rates because inflation's gone, and that's good too. And, normally you might think, well, if the economy is so great, why do we have to have rate cuts? After all, rates are not high by historic norms. I mean, if you go back to pre-2008 financial crisis, or really pre the bursting of the dot-com bubble, interest rates where they are right now are pretty much normal. And given the fact that we have a lot more debt now than we had in the 1990s, and we have a lot less savings, you would think that the normal rate of interest would be somewhat higher than what it was, in the 1990s or the 1980s, when we had less debt, more savings, and we were more creditworthy as a nation. And in 1980, the government had a much smaller national debt than it does now. I mean, anybody knows who's borrowed money, which is pretty much everybody in America borrows money. You're always looking at your credit score, your FICO score. And the lower your score, generally, the better terms that you can get on a loan. Why? Well, because you're a better credit risk. The lenders are looking at your credit history, looking at your total indebtedness, your income, your debt relative to your income, to try to assess your ability to pay and the likelihood that you'll not pay, default. And so, the less debt you have, the lower your debt to income, right, the better terms you're going to get. More people are going to want to loan you money, and they'll loan you money for a lower rate of interest. Well, if you apply those standards to the United States, I mean, our FICO score should be in a toilet. I mean, forget about the fact that we have had slight downgrades to our credit rating, which we didn't have back then. So we have a lower official credit rating, but it hasn't been lowered nearly enough to reflect the deterioration of our financial circumstances. But we have much more debt now, right? The national debt is 34.1 trillion and rising. We have a couple hundred trillion of unfunded liabilities. Back then, back in the 1980s, 1990s, we were still pretending we were going to do something about entitlements, about Social Security, about Medicare, that there was going to be some effort to, fix the problem before it blew up. Well, nobody at this point believes that we're going to do anything about stopping the bomb from going off. In fact, it's already gone off. We've already passed the point.
In this next segment, Peter Schiff issues a dire warning. Social Security is officially broke, running in the red due to insufficient tax revenues. Trust funds, meant to bridge the gap, are rapidly depleting their treasury portfolios. This shift transforms government debt dynamics, as bonds once owned by the Social Security Trust Fund are now being sold to the public, becoming a net drain on the US Treasury. Adding to the complexity, Schiff highlights escalating issues with student loans, where nearly $2 trillion has been forgiven, posing a significant loss for the government. The restart of student loan repayments post-COVID faces challenges, as borrowers have adjusted budgets during the payment hiatus. Schiff emphasizes the potential moral hazard, suggesting the belief in future loan forgiveness may dissuade individuals from repaying. The looming danger, as outlined by Schiff, is a combination of a bleeding social security system, a growing deficit, and the impact of forgiven loans on government revenue.
Social Security is officially broke right now because the tax revenues are less than the expenditures. The system is already running in the red, which means it has to loot the so-called trust funds. The trust funds are now liquidating their treasury portfolio, and it'll be completely gone in a few more years, right? Which really doesn't matter because the government could sell bonds without the trust funds selling the bonds. It just is an official acknowledgement that those trust funds are empty. And again, the only significant difference is that when the bonds were owned by the trust funds and the government paid interest on the bonds, it paid interest to itself. So it really didn't count because the government took the money out of its right pocket and stuck it in its left pocket. So it didn't really cause the government any money. But now that the Social Security Trust Fund is having to sell these bonds to the public in order to get the money to make the Social Security payments, now these bonds are owned outside a government trust fund. And so now when the government pays interest, it's not paying it to itself. It's paying it to somebody else. So it's a net drain on the U.S. Treasury, and that drain is getting bigger every day as more people retire, whether voluntarily or involuntarily, and more people just drop out of the labor force and stop paying taxes. So fewer people are paying payroll taxes, and maybe some companies will be able to automate, use AI or whatever to eliminate some workers, and they're not going to replace them with other workers, and so they're not going to be paying Social Security taxes. The computer programs don't have to pay into FICA. So all this is going to get bigger. But given the fact that we have this huge hole in Social Security and we're bleeding, we got a massive deficit that's running out of control. We have all these problems. We got student loans now that we're forgiving. I mean, we weren't forgiving the student loans back in the 70s or the 80s. We were just getting started making those loans, right? So people still believed that the students were good for the money and they were going to pay it back. Well, now we know that they're not good for the money. They're never going to pay it back, and they don't even have to because we're forgiving the loans. But again, when the government forgives the loans, it's not getting that revenue. It was supposed to get the money back that it loaned out. We have almost $2 trillion. That's an asset that the government had. Yeah, it was a liability to the people who borrowed the money, but it was an asset to the U.S. government. Well, now it's not getting that asset. In fact, even though they've restarted the obligation to pay student loans, I think I read only about half the people who stopped paying their student loans for 2 or 3 years because of COVID, now that they're supposed to pay them, they're not doing it. And I think the reason they're not doing it, well, there's a couple of reasons. But one is, once we kind of got them into a situation where they didn't have to pay, and what they did with the money is what all Americans do with money, is they spent it. So the minute they didn't have to spend money on student loans, they started spending that same money that they would have sent to the government. They started spending it, at Amazon or whatever, or they just at the grocery store. They started spending the money, and they adjusted their budgets to need that money. And so now, after 2 or 3 years of a moratorium, when the government says, okay, everybody, now you got to start paying your student loans, the people don't have the money anymore. They've already redone their spending without the loans. Now they have no room. And so they just don't have the money. But also, I think we've gotten people to believe at this point that they don't really have to pay their student loans back, because eventually it's all going to be forgiven anyway. And so why pay? I mean, I think we've created that moral hazard that you're an idiot if you make your student loan payments, because nothing is going to happen to you if you don't make them, right? The government's not going to come after you. They're not going to put a lien on your wages or your salary. There's no negative consequence. I don't even think your credit score is going to be impacted if you don't pay your student loans. So why bother to pay them? What's the incentive?
As we conclude today's exploration into the economic insights shared by Peter Schiff, it's clear that the US faces significant challenges, from the Federal Reserve's rate-cutting measures to the looming issues with Social Security and the student loan predicament. We value your perspective, so share your thoughts on these critical economic matters in the comments section below.